Investors Chronicle.
Companies and Market Show, Thursday the 19th of May as we record. On today's show, our result of the week is Vodafone and BT. Arthur Sants joins us to talk through those. We're also talking inflation and supply chain worries. Are we heading back to the 1970s and what can the Bank of England do about it? And then we're having a look at private equity, given the rampant appetite for all things UK publicly listed companies. All that and more. Let's start the show. Companies and Market Show. Hello, listener. Welcome back. Exciting show for us because everyone's in the studio here in person for the first time, which is nice. Julian, you've made your way down from Devon.
I have, yes. It's a great pleasure to be here in the bowels of the FT.
What do you think of the studio?
It's very much sort of Battlestar Galactica, but quite like it.
Alex Newman, hiya.
Hi, John. How you doing?
Yeah, really good, thank you. Arthur Sants joining us. Hi, Arthur.
Hey, guys.
Welcome back. And Dan Jones talking us through our topics later. What have we got coming up today?
We've got a few things today. We've got the joint result of the week, which is Vodafone and BT. We have got perhaps some inevitable chat about inflation, supply chains, what have you. And then we're talking about the increasingly frequent private equity raids on UK PLC.
Beautiful. Looking forward to that. Well, before we get to that, though, I'm going to go through my little news roundup of the week that's been. Let's start with the markets. With US shares on Wednesday recording their biggest one-day drop since the early pandemic. One of the biggest fallers was retailer Target, which dropped 25% after it warned on profit margins due to rising costs. Walmart similarly downbeat the day before, losing 11%. It left the S&P 500 down 4% for Wednesday. Meanwhile, the Dow was down 2.5% and the Nasdaq down 4.7% as tech continued to sell off. European market losses are there too, but slightly more muted than the US so far this week. Some inflation stuff, a 40-year high for both consumer price inflation and retail price inflation in the UK. CPI hit 9%, RPI 11%. Andrew Bailey, Governor of the Bank of England, on Tuesday insisted the central bank couldn't have done more. Neil Wilson, the writer of our Markets Roundup, disagrees rather strongly. Don't know if anyone's read his newsletter this week.
I have, yeah. As you say, stern words. For
P45, really. I think, was mentioned.
It was.
Oh,
dear. Elsewhere, the European Commission announced a €300 billion plan to wean the continent off Russian gas by boosting the amount of renewables generated. The strategy has increased the target for renewables production to 45% from 2030, up from 40% currently. It pledges to speed up the approvals process for projects and set new targets for domestic solar, wind and hydrogen production. A few companies updates. On Monday, Made.com shares plunged 15% to hit a record low as management slashed sales and profit expectations for 2022. The online furniture retailer is minus 64% year to date. Vodafone has a new shareholder. Emirates Telecommunications Group has purchased around £3.3 billion of Vodafone shares to give it a 9.8% stake. Vodafone, one of our results of the week, coming up in a few moments. And Greg said that full-year expectations remain unchanged despite sales struggling in bigger cities and increasing cost challenges. Shares fell 0.5%. Online, we have updates of plenty of other companies, including the likes of National Express, Life Science, Watches of Switzerland, Burberry and SoftBank. Lots to get your teeth into there. And finally, a little closer to home, the IC's veteran economist Chris Dillow has sadly, for us if not for him, retired this week. He sat down and spoke to Mary McDougall in Wednesday's IC Interviews podcast about the lessons he's learned from his 35 years in the industry, what country music tells us about the US economy, and much more. It's a great discussion, so please go and seek it out. It'll be on the same feed as this podcast, and we'll play a little of it at the end of the show as well.
Thanks, John. Yeah, we are going to start, as we said, with telecoms. Historically not the most exciting sector, a sector that's been in structural decline perhaps, but despite or maybe because of that, there's been plenty of news flow lately, I think it's fair to say, across Europe and the UK as well, largely in terms of BT and Vodafone, in terms of stake building, as you alluded to just then, John, which we'll get to in a minute. But we'll start by looking at the results themselves. Both companies reported in the past few days. Arthur, you are our telecoms man. You've covered both these results. What's the takeaways we can get from them?
Yeah, so
I'll probably start sort of chronologically. So BT's results came out first in the week. The story of BT is pretty well known at this point in that they have been investing loads of money in Openreach, which is their fibre optic network across the UK. And it's expensive. And last year they spent over 5 billion on CapEx, and these sort of CapEx figures are expected to stay pretty high for the foreseeable future. The sort of concern with BT in the current environment is that sort of investing in Openreach is expensive from sort of raw material perspective, and also paying people to do it. And as everyone knows, sort of wages are going up, although Andrew Bailey's trying to keep them as low as possible. And that's going to sort of increase the cost of probably doing these installations going forward. And then the other concern, I think Newman made this point in one of their notes, is that BT is, to sort of generate returns on this Openreach investment, is going to want to push up prices a lot, and they'll probably justify that by being like, oh, you're getting way faster connectivity. And then when they move people over from their sort of old copper wires into their fiber optics, they're expecting to sort of increase prices quite a lot. But I guess the concern for them now is that how much will they be able to push through those price rises if there is this big cost of living crisis. The big difference between BT and Vodafone is that BT is basically a British only company. Obviously they have BT Sport as well, but they've actually just signed a joint venture with Discovery. BT Sport was like losing them quite a lot of money paying for these expensive Premier League rights. They've also sort of talked about automation. They have an AI chatbot called Amy. So as customers, you can go and talk to a computer instead of a person, which hopefully might save them some money. But
all customers unanimously, I think, love chat.
I think most of us are probably quite skeptical. And so they've sort of been trying to cut costs elsewhere in the business, and the big thing is the BT Sport joint venture. Vodafone is like slightly different from BT. Vodafone is trading on a higher multiple. I think it's on like 11, whereas BT is on around 8. Part of this sort of justification for this multiple is Vodafone's a much more international business. It's got a global business which isn't doing that well, but the majority of its revenue, like the large majority, is generated in the UK, whereas Vodafone's got like a big German business, and the margin in the German business is like over 40%, whereas in the UK, Vodafone's margin is in the 20s. And Vodafone's also got this big African business that's actually growing quite quickly, and they have like a fintech app as part of their African business, whereas BT's not really growing that quickly. Vodafone does actually have some growth markets and some other higher margin businesses elsewhere in Europe. But Vodafone's under a little bit of pressure. I think the Italian and Spanish businesses' revenue's been slipping back the last few years. They're pretty competitive markets, and like with telecoms, it's just like very hard to differentiate yourself. So if there's like a lot of competition in your market, you can only really compete on prices. And they've got a new activist investor called Civian, a Scandinavian product company that took a stake in Vodafone a month or two ago, and there's some reports that they've been putting pressure on the Vodafone board to sort of speed up some of its sort of restructuring. They had a bid for their Italian business, £11 billion bid for the Italian business, but they rejected it. But there's some thought that they might try and sell off maybe the Spanish and the Italian businesses. And then there's also other reports that they're going to merge with Three. I think this which would put together like the third and fourth largest telephone providers in the UK, which is kind of like where industry is going, is that there's so much competition. It's pretty hard to compete when the products are all the same. So there will be some consolidation.
Julian, I'm going to bring you in because you've been clanging in the background, which I'm going to pretend is you wanting to make a point. What's your?
It's really horrible, isn't
view?
It? So yeah, it's an interesting one because I wrote about this before. I think Arthur took it up, and Vodafone particularly is quite interesting in terms that they do have markets where they can protect their margin to a certain extent. As you pointed out in your article, it's Germany where they seem to be most profitable in terms of what they're doing. And if those of us with longer memories will remember the disastrous takeover of Mannesmann that Vodafone did in order to to build that business, which they then had to write down for about 7 or 8 years afterwards. But there is no movement on price. We can all just change contracts if we don't want to stay with them. I think most of us at least do one change a year, and they don't have a lot of flexibility. And BT in some ways is a classic example of that. Although I did want to add that they have got an easier ride from the regulator on their pricing for the new fiber broadband network. So they apparently did get a better deal than many people were expecting. So the pricing could hold up, but they have to spend so much money just burying cables in the ground. It's whatever it looks like in the long run, they're going to spend an awful lot of money on it. But
I suppose the obvious sort of question bringing this all together, we'll get to the activists. We'll come back to them in a minute. But in this kind of environment, where you've got a sclerotic but maybe relatively stable business, which compared to most things right now looks quite attractive. Share price doing single digits a year. Most people will snap your hands off for that right now. But in an inflationary environment, we talked about these prices and the ability to maintain margins. Are these the kind of companies you might want to look at? Is the jury still out there? It's a difficult one given all the various markets in which they operate, right?
Yeah, well, I think they've also both got pretty decent dividends. I think Vodafone was like 6% yield and BT was in the 4% yields, which are pretty good. And I think there was some discussion around whether BT should not have its dividend and be investing more in improving the business. But at the moment, I think any investor would be pretty pleased that they've got their 4% dividend intact, because at least you're gonna get something. So and actually I think they've held up pretty well. I think initially in the sort of tech sell-off, both of those companies share price came out quite a lot. They've come down a bit later, but maybe that's indicative of investors sort of looking for more value businesses. And although prices can't go up a lot, like people still need telephone contracts and broadband. Like, it's going to be one of the last things that people are going to cut out of their expenditure, isn't it?
And also, you can also imagine that BT will find more costs to cut. I mean, there's a guy who lives down the road from me who used to work for them, and he told me that they managed to lose 100,000 employees without a single forced redundancy. So it kind of shows you there's plenty of fat there to cut, and there might be some more that they can skim out of it.
So the other point it occurred to me as you were talking just then, Arthur, on the capex front, and I suppose that you could look at that as from an investor's perspective with slightly nervy eyes, that everything remains very, very tight. But if we skip back like a year ago to the some of the emergency measures that were being brought in, BT is probably the greatest beneficiary of the super deduction tax, which allowed companies to basically gave them a sort of 25% bonus on everything, all plant and qualifying plant and machinery that they invested in, both in the most recent fiscal year and the one we're in now. So it's kind of a no-brainer for them, even if with inflation running hot, to double down on a plan they already had in place. So it doesn't change for me the commoditized nature of the business they're in, but it does make sense for them to be investing heavily. And I mean, the point Arthur made on where internet spending comes in a household budget now, it probably is a bit more solid and a bit more premiumized, if I'm allowed to use that word, Julian.
Yeah,
you banned it. You banned it this morning. In the sort of pecking order of kind of must-have essential items. But
there's the other silver lining, I guess, for BT right now, of course, is the pension deficit, which rising gilt yields are not always a great sign for many people, but for BT are quite helpful. Of course, if we were to have an economic deterioration, one might assume that gilt trend might reverse. But let's turn to the activists. John mentioned the new stake in Vodafone earlier this week, but that seems to be a bit more of a silent partner for now. But Vodafone and BT both have people on the board now who are looking to shake things up a bit. Obviously, Vodafone is trying to divest businesses fairly quickly. What do we think the end game is here? Is it in both cases, a slimmed down business focusing more on core markets? Is it, spin-offs, that kind of thing? Do we have any kind of sense of what the companies, what the activists might be looking for?
Well, yeah. So BT, it's Patrick Drahi, who's a Israeli French businessman who has a company Altis, and he has like a 12 to 18% stake. I think it's probably slightly different. Like BT, its global business, which shrunk last year, seems like they could maybe be looking to sort of dispose of the global business. They've obviously already done the joint venture with BT Sport and Discovery, which was the most obvious one. So there's probably less sort of corporate activity at BT than there potentially would be at Vodafone, just because Vodafone's sort of a more sprawling company. And Vodafone, it looks like, well, obviously the Italian business has already had a bid for it, which they turned down, and I mentioned earlier in the Spanish business. So I think at Vodafone, maybe you would see and maybe this is what Sivian is saying, is that maybe you sell off the Italian and Spanish businesses, which both saw revenue shrink last year, and then focus more on the core markets, which obviously with the 3 tie-up in the UK, they see that as one of them. And then, despite the disastrous German acquisition Julian mentioned earlier, I think Germany would probably be another one of those core markets. And then they're very keen on growing in Africa as well. So I don't know what conversations are going on in the background, but clearly these investors taking stakes in these companies means they expect them to generate value for them in the long run. Probably if you're from an investor perspective, you're going to be pleased about these people taking these stakes in both BT and Vodafone. I think the tricky thing though is that they're just like tankers. It takes so long to turn around these businesses. Technology moves forward, and who do you know? Like, you don't know what's going to happen again in the future. Like, BT's invested like up to 15 billion in upgrading into fiber optics, and then I don't know, Elon Musk puts a bunch of satellites into space to do Starlink, and suddenly he's like beaming Wi-Fi down to everyone. I think that would, in the like medium to long term, like it just seems stuff moves on, and these companies have already invested huge amounts of money in 5G in Vodafone's case, and like BT and Openreach, and then suddenly some new bit of technology comes along, and the way we all communicate with each other changes massively, which is probably why they are not insanely expensive businesses, because it's just like they move slowly, and then other stuff moves faster than them, and then they're sort of left behind.
Let's move on to the macro and inflation, supply chains, things like that. They're still very much at the forefront of investors' minds, of everyone's minds, really. Obviously, CPI inflation in the UK hit 9% this week. Andrew Bailey attracting plenty of negative headlines again, not without reason. I suppose what's changed maybe in the past couple of months, or not changed, but come to the fore a little bit more, is the kind of the dreaded stagflationary fears, where we're looking at, the Bank of England's inflation report. They're sort of, trying to do what they can, or they say they're trying to do what they can with regards to inflation, but at the same time they're conscious of, a recession might be coming down the line as well. Why don't we start by looking at, obviously what we want to do is work out what this means for companies themselves. One thing, Arthur, you looked at last week, in last week's edition, was productivity gains and companies, who've already been through a few quarters of inflationary pressures, or longer in some cases, and what they've been doing to try and mitigate that, and also who those companies are.
So there's the way I was thinking about it was the companies that have already been under a bit of inflationary pressure, because these supply chain issues have been going on for a while now, have been sort of responding by sort of improving their operational efficiency. Either they are consolidating warehouses where they can store everything together in the same place, or investing in machinery or technology to sort of improve the production process and make it faster and cheaper. And to sort of find those businesses, I looked at the difference between gross and operating margins and tried to find the companies where they were closing that gap. Because your gross margin might fall a bunch because costs of labor and raw materials goes up a lot, and that's within reason somewhat out of companies' hands. But if that gap is closing, it means that they're improving sort of the operational efficiency side of the businesses. And then a few of the companies that Games Workshop was a good example of a company who have been doing this. They managed to narrow that gap, and although Games Workshop, their margins fell last year, their gross margin fell by 6 percentage points because they're shipping these little figurines around. They make these. If you guys haven't heard of them, they make these little fancy figurines that you can play with, and they produce them all in Nottingham. Then they ship them to distribution centers. One of them is in Memphis, Tennessee, and the cost of doing all that shipping and stuff had dropped their gross margins. Also, they increased their headcount and were paying people more money. So that also hit gross margins. But they sort of narrowed that gap between the gross margins and the operating margins. And for example, one of the things they did was investing in new technology in the Memphis, packing technology in the Memphis distribution center. And they had 5 million of backlogs in November, but they managed to clear them by January with this new investment. So it's a good example of a company that has sort of been under pressure and then has responded by making their company more efficient. A bad example, although slightly exceptional example, would be British Airways, which is they have some issues and then they fire 10,000 of their employees, and then it's suddenly demand comes back for their product and they can't find people to man these planes. And British Airways has now had to cancel a bunch of flights going forward into the summer because they can't find people to man these planes. I think that the companies that sort of respond to this by redundancies or cutting wages, etc., it's because they're definitely very sort of short-term thinking. And if you can respond to rising wage inflation by investing in technology to make your workers more efficient, that actually will make the sort of if you can make your workers more productive, paying them more money isn't really an issue. They're still going to be producing more. And Amazon has just launched which has been absolutely hammered by wage inflation and is making a retail loss in North America for the first time since 2015, has launched a £1 billion venture fund to invest in startups that can help improve efficiency. And there's weird robotic arms with AI technology and stuff to work alongside people. Amazon's always at the forefront of doing weird technological investments. But I guess the fingers crossed for me is that rising wage inflation will actually drive investment and productivity growth. And for investors, it's about maybe finding the companies that are tackling this through innovation rather than just through firing lots of people.
I suppose there's always the question of timing, though, on that as well. Walmart, we spoke about earlier this week, they've said in their results, they're investing a lot in CapEx in exactly that kind of thing, trying to improve efficiencies. But, the bottom line was very much a reduction in growth they're already seeing right now as a result of these inflationary pressures. So, sometimes that immediate bottom line is being focused on understandably more than the long-term plans. But if you're a long-term investor, you can perhaps afford to wait and reap the benefits.
Well, that's the problem, isn't it, with capital spending? Because it takes 90% of effort to produce 10% of gain, doesn't it? So economically, they could wait 7 years before they see any benefit from it. But that's why it's always better to burn your factory down and then rebuild it, because it's cheaper than replacing the capital stock.
Well, if we start seeing that happen, I think we know we are in tough times indeed.
But I thought, Arthur, the piece is really interesting. You drew a parallel with, and I mean, different era. We keep coming back to the comparison with the late 70s, early 80s, because I suppose the inflationary, and some of the geopolitical backdrop. But you looked at Ford and how their improved productivity drive lifted their sales per employee ratio considerably in the 80s, and actually on a long-term horizon that was a brilliant investment if you had made it in the sort of the teeth of that efficiency drive in the early 80s. It's something like the ninefold return over 5 years.
It was Lee Iacocca, wasn't it, who did that, I think? The chief executive at the time.
Your knowledge of industrial titans is much better than mine.
Well, I don't know. I mean, what else do you read these days?
Exactly. But yeah, I mean, I don't know the union question there is very different today, and arguably Labour has a smaller bargaining chip. That throws in a different element to the equation. But yeah, if you're a long-term investor, when that's what we write about, it's not just focusing on the sort of day-by-day trading gains or losses. I don't think I don't think it's clutching at straws to focus on that as a silver lining, which is, I mean,
Yeah, the other nice lesson from history I found out the other day. So the Industrial Revolution, I think people always, the steam engine was patented by Watt in the late 18th century, but then it was the 1833 Factory Act that basically stopped people from employing children from the ages, I guess 12-year-olds were working in factories back then, and also it limited the amount of time that workers could be forced to work in factories. And so it was 60 years or whatever after this steam engine was patented that then all the factories started using steam power in their factories, because they we can't use children anymore, so we'll use steam instead. So actually there's a situation where when your sort of labor becomes more expensive, or the amount of labor around gets restricted, then you're forced into making these innovative changes. And then obviously Industrial Revolution increases worker productivity hugely. So lots of good examples from history where rising wages actually makes companies more efficient. So that's
Well, actually, it might be a permanent situation, because if, like me, you're a devotee of Freight Waves magazine,
I was about to make the segue from child labour to overseas workforces.
Well, because there's this thing there's this idea that the reason that we enjoyed such prosperity over the last 30 years was because there was a buffer of goods and labour that could produce things cheaply. So you had populations in Asia that you didn't have to pay a huge amount. Raw materials were generally quite cheap in the 90s after the end of the Cold War. And the supply chains have developed in order to take advantage of that. And what Freight Waves point out is that the cost of doing everything might be permanently higher now, because you have far less employable cheap labour in many markets, say in Asia. And there's also an interesting point about how ESG regulations are also starting to impose on how you can run things around the globe. So it's not just a kind of investing concept that we sort of look at in the abstract. It's actually starting to affect the way that people are doing business all around the world. So I thought that was quite an interesting point. I read that at 5 o'clock this morning when the Germans woke me up in my youth hostel.
I will skim over that, and because we do all sort of think about, don't we, about when supply chains improve, you think, oh, out of the pandemic and now Chinese lockdowns, you think after that, but you're right, it may just be we have to get used to this new world, this deglobalized world, and everything that means for companies, for economies. Let's leave or park inflation for the moment, but only insofar as to say that the monetary policy reaction to that has caused some concerns this week. I think it's probably best for our listeners' blood pressures if we don't go into too much detail, perhaps on the Bank of England. But what we have seen in the past couple of weeks, with the US and the Fed, going to hike rates a lot more, with a bit of a flight to safety as well, is the dollar strengthening a lot against sterling and other currencies. That has meant more sterling weakness, and we're already seeing we're seeing right now, even before all this, a lot of interest in UK companies from overseas buyers and also from private equity. And in particular, we've seen that again this week. Contour Global, the deal there, HomeServe, just today as we speak, has firmed up its takeover effectively. So, I mean, there's been a lot of talk about this over the past maybe 18 months, that kind of thing. It does seem to be accelerating even more now. Private equity is interested in the UK. The valuations are better, perhaps, it's fair to say, in the UK than elsewhere. Julian, maybe we start with you, because you've been writing about HomeServe this morning. Just your thoughts on the PE interest in UK companies.
It's an interesting one. It's a bit of a paradox, actually, because we're 5 months into the year. Yes, I got that right. And the actual level of deals has slowed down dramatically from last year. So there was something like 23 billions worth of deals in the top 10, and so far this year it's not even broken 6 billion. So it's kind of a year of two halves. We might see it going a bit higher as the year progresses. Share valuations are now getting to the level where public companies in the UK are very, very discounted to almost everywhere else, even though that Wall Street is also being hammered. But yeah, so the trend seems to be distinctly towards buying buying up UK PLC with private equity money, and also it doesn't seem to have affected. The thing I came across today was it doesn't seem to have affected any kind of fundraising for it. So whatever the market turbulence has been in the last 3 or 4 months, private equity firms are still accessing quite significant amounts of syndicated loans from banks, and I think that's quite a telling detail. I mean, if they really are armored up to do more deals, then we should see quite a lot more in the second half. I think that's definitely something to look out for.
I think it's all about time horizons at the moment for the PE takeover story, because on the one hand you've got all this money they raised last year when times were happier and there's loads of liquidity sloshing around, but in an inflationary environment that's just cash whose value is eroding away now. So they will have identified lots of companies, and yes, the picture is now obscured by all the inflationary pressures or slowdown in economic growth or recession. But if you're taking a 3 to 5 year time horizon, which lots of PE funds do, then it just makes sense to kind of look through that and deploy some of that cash now. And then at the same time, I think you have, publicly listed companies, they are facing quite a difficult year or two ahead. I mean, earnings are probably going to miss expectations this year. If you're managing a public company, I mean, my sense is that you might want to do this out of the public eye, and if there's a bid opportunity before you, which is at a decent premium, it's much more attractive to be doing this out of the glare of public markets than sort of hanging in there and watching your share price slide while investors get more and more bearish about the outlook. So yeah, this time mismatch, I think. Yeah, I completely agree. I think there's going to be loads more deals coming.
We can see with Home Serve that the chief executive and his wife own 12% of the company.
Yeah.
So you think, well, they don't want to sit on a depreciating asset. So selling up at 70% premium is probably the best possible deal in that sense, isn't it?
Yeah, that's a chunky premium, as you say. We have had a few bits in our pages this week talking about some of the perhaps slightly more subpar offers coming in, Randall and Quilter being one mentioned in the Bear Bull column. And that obviously can be a frustration, can't it? If you are an investor in public markets with yourself a long-term time horizon, and you're being denied effectively the opportunity to see those things play out. One interesting thing on this front I did see from Schroders a couple of months ago, I think, on talking about overseas takeovers, private equity takeovers in the UK market. We seem to keep returning to Germany this week, but over the 10 years to the end of last year, there were actually private equity accounted for a larger proportion of takeovers in Germany than they did over here. So I think sometimes perhaps we think this is a UK only story, but it really is happening everywhere. I mean, KKR, I suppose, another example. Contour Global this week, they've been making their presence felt in UK markets, but equally, they attempted to buy Telecom Italia the other week, didn't they? And which didn't quite work out. So this dry powder is being spent all over the world, and unfortunately, if you're a public investor, you just have to often you have to like it or lump it if you're if one of your companies is involved.
But the German point's quite interesting, isn't it? Because one of the reasons there is that trend is because there's a lot of German companies with very big family stakes, and often those conglomerate structures don't go anywhere in terms of share prices because they tend to be they have lots of cross holdings and there's never any movement. And so actually selling out to a PE company is one way of generating your inheritance tax bill if you own it, but also because the institutions over there have become far more open to the idea. So it's like German banks are starting to fund it themselves, and they have a vast collection of savings that they can just shove into private equity takeovers without affecting anything on their balance sheets.
Yeah. Obviously, Julian, you had this conversation at 4 a.m. over breakfast in the German YMCA today. So
yeah, actually, no, I'm buzzing.
Okay, I think that's all we have time for this week. But before we go, I'm going to hand back over to Arthur, who's going to talk a little bit about our new newsletter, The Squeeze.
Thanks, Dan. So The Squeeze is a newsletter that sort of I write, but with the help of other colleagues. And it's for this week, It comes out every Friday morning. So tomorrow morning, recording on Thursday. And this week it's sort of touching on a topic that we've discussed on the podcast, but about how rising wages can actually lead to productivity growth. And will be an article every Friday, plus there'll be a sort of selection of news stories from the week that we think will interest the readers.
Fantastic. Keep a lookout for that in your inboxes. And if you haven't signed up, please do. You can find it on our website.
Companies and Markets Show was hosted by Dan Jones and edited and produced by me, John Rogers. Don't forget to head on over to Apple Podcasts, drop us a rating and review. We'd love to hear from you. Before we finish, here's a little bit of Chris Dillow speaking to Mary McDougall on the IC Interview podcast.
I hear you're a big fan of country music, and specifically of Hank Williams.
Jambalaya, crawfish pie, a filet gumbo.
I wondered what you think country music can tell us about the state of the US economy, to bring it back to topic.
Well, that is actually a far more intelligent question than you might think, because music is a sociological document. For example, Bruce Springsteen's album Born in the USA, released in 1985, told us about deindustrialization and about the threats to American identity coming from the sense of American decline. He was onto it a lot earlier than politicians and your hillbilly elegy guff. So in that sense, music tells us something. Similarly, the popularity of drill music in inner cities tells us about the violence and dangers that the urban youth are confronted with. So music does tell us something. And the thing about country music in America is that on the one hand, it's incredibly diverse, but on the other hand, American radio in particular plays only a fraction of what there is out there. It doesn't play your Sturgill Simpson very much or your Billy Strings, and it plays very, very few women artists. What it tends to be dominated by is men in hats singing about beer and pickup trucks and such like. And what that tells us is partly that there are contrasting trends in America between, on the one hand, the diversity of ideas and identities, but on the other hand, the urge to suppress that diversity and have us monopolized by a particular identity. But on the other hand, this sort of cliched, hackneyed country music does hint that there is an assertion of traditional masculinity in the face of threats to that masculinity, coming, for example, from economic decline, and in particular, the fact that there's much less role for semi-skilled and unskilled male workers than there was 40, 50 years ago.
That was Chris Dillow speaking to Mary McDougall on the IC Interview podcast. Go and check that out on the Investors Chronicle podcast feed. Thanks for listening. Bye-bye.